Another day that comes out, another impact from Washington, this time in the form of a tweet occurring and impacting geopolitical risks or increasing geopolitical risks. So I'm going to break down the impacts on that on the market. Was it as big as it seemed based on what we read and hear about? Or did we have a pretty darn neutral day? And how does that alter our expectations we had from a technical perspective heading into today? And is there any patterns coming out that we can look for in the next day or two that can either support those expectations or change them? And of course, we have had some big moves within this quietness. We've had some big moves. Today's trade idea will take advantage of that. So let's go ahead and get started. Today is Wednesday, April the 11th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching us tonight. Welcome to those that are watching us for the first time. Thank you. Welcome. Keep coming back for more. Subscribe to our YouTube channel by clicking on that Market Scholars icon. You can see that in the bottom right corner of the video. Just hover over that and click on the subscribe button. Comment on anything that stands out to you from today's video. You can see the comment section down below. Also, click that thumbs up icon. That lets me know two things. Number one, it tells me that you like the video, that you got something out of it today. Number two, it tells me that you want me to do it again tomorrow, to do another video like this again tomorrow. So one click, easy way to tell me what you're thinking. Join our daily email list, Market Outlook email list. You'll see a link down in the description below that will take you to the spot to join for that. Follow me on Twitter for more content like this throughout the day, throughout the week. You see my handle on the screen, at DavidSettle42. Like and retweet tonight's Market Outlook tweet. Also join our Market Outlook Facebook community. You'll see the address at the top. There's also a link down in the video description below that will take you there too. We're about 1,000 people strong that watch these videos and interact, so join us there. All right, well, let's take a look at the S&P 500 with the market forecast indicator. To start us off, and you see our posture has turned sideways. So again, we're not very bullish here. We're not bearish either. We got this kind of weak bullish posture. I mean, you can even technically say we're bearish because we're at 33.09 versus 33.29. But the reality is, it's pretty sideways because it's having a hard time getting through resistance in this area. There's a lot of volume right here. Between 2650 2675, a lot of volume that's having a hard time busting through. You know, it tried there, but low range, small range, low volume, wasn't able to maintain, and so it looks like it's trying to figure out whether it wants to come back and make another run towards these lows where there's a lot of volume down here too, between 2575 and 2600. Momentum line fell. But it only fell to 8, and you know we only really care when it falls to an extreme, and that's defined on the downside as below the 5th percentile. So at least we're above that. Near-term line still rising, would be forming a bearish high point, so it'd be lower than that one if that's the case. But it would just be coiling. Now, if we continue to coil here, then again, the expectations to break out of that coil will be to the downside. Now, you never expect support breakouts or resistance breakouts, right? You always expect those to hold until they don't. But regardless of what the support and resistance looks like, if we do continue to coil, the expectation, just based on that price pattern alone, would be for breakout to the downside. Now, the support kind of nullifies that a little bit, but you know, that would be the danger right now if we continue to get high near-term highs here, successive near-term highs here, and successive near-term lows in this area without busting through to a higher high, higher low. And that's, as of right now, we're not doing that. And considering the trend is kind of sideways neutral with a little bit of a bearish bias because of how low it is, you know, right now there's not a whole lot of expectations to bust out to a new high anytime soon. Now, if we were to get above this 2675, away we go to the upside. Easily going to start to fill in that range, as you'll see here in a minute when we look at the intraday chart. But again, you don't expect resistance to break until it does, right? So it's like, okay, which one of these are going to break? Based on the price pattern, we expect that support to break first. But based off other things, you know, there's 200-day moving average. There's all this Fibonacci support here. There's multiple layers of support in this area. for multiple different factors that you would say, okay, well, based on that, again, based on the price pattern alone, you'd expect a breakout to the downside more than the upside. Based on the fact that there are multitude of layers of support here and not as many layers of resistance here, you'd expect it to break out to the upside eventually. Eventually to the upside. But, again, we're not backing up the truck expecting that breakout. We're more just kind of riding this indecision right now very tentatively. Let's look at the Dow Jones Industrial Average, and you got so many lines. You can see that coiling action coming along the Dow Jones as we're coming along this downward trend line here, and not really able to get above this longer term trend line or get below it to the upside. You can get rid of these. These are these accelerated trend lines. But that's our coil action going on right now on the Dow Jones Industrial Average. And we're, that moving average, you can see a little bit below that line is also kind of sitting there for some resistance too in the short term. Its intermediate line is turned down slightly too, from 35.5 to just under 35. So almost same exact pattern. That one did dip down to the 5th percentile on the momentum line, so a little bit more of a sell-off there. The NASDAQ, you can see its intermediate line did not turn slightly down. It's kept going slightly higher. You can see its same issues it's having with its resistance around 7,100. Its near-term line also making its way towards the upper reversal zone. And finally, the Russell 2000, more bullish than the other indexes, so small caps, and you can see, trying to get above that. Can't quite get close above these highs, but we did close above that downward sloping trend line. So a positive development for stocks, and that small caps are showing a more positive pattern. And you can see intermediate line rising better at a better pace, still weak, but rising at a better pace than the others. And then the near-term line getting up into the reversal zone again, coming up off of what would be a higher near-term low point here, and making its way towards another potential bullish near-term high as we get up to a slightly higher high as of right now. So not out of the woods, because you see that 50% Fibonacci retracement. Let's do more. What you can see here. Here, let's move this to there. And you can see we're right about at that 50% Fibonacci retracement level. You're not quite above the moving average. You haven't closed above these highs where my cursor is. So, bullet looking good, but not out of the woods, right? We still need more confirmation before, that posture strengthens and we feel better about balancing our active trading portfolio back towards that bullish bias. Really quickly, I wanted to remind you, if you're watching this video, embedded here in the blog post on marketscholars.com, remember, here's where all your controls are. For example, to change the speed and the resolution of the video. You can see it full screen here by clicking on that video. You can play it on your TV if you have like an Apple TV or something. You can share it from here, or excuse me, a Chromecast. While you're here, this is important to us. While you're watching, you can click on this like button to let us know on Twitter here. This is the tweet for tonight's Market Outlook tweets right below the video. Clicking on that like button lets us know you want us to keep doing this videos, right? We don't charge for these, right? So the only way we know you want us to keep doing it is when we see this number, and the higher it is, then we know you want us to do it again tomorrow. And same thing for those of you who have Facebook, Pat. In fact, you can do both. Click this like here too, and that will also tell us with 1 click or 2 clicks if you do both of them, or 3 clicks if you do it here on the blog as well, that you want us to keep doing these videos. And the more clicks we see across all of these, the more you're telling us that. And the benefit we get out of it is Twitter sees all that engagement and says, we got to push this out to all of his followers. Same thing on Facebook. Facebook's even worse. Their algorithms are a lot tougher. So the more of you who have Facebook accounts that click that like button there, then the more Facebook will push this out to all the people that follow the page. There's 1,000 people that follow my page, and you can see, a number like that, doesn't necessarily tell me that I should keep doing these videos here on YouTube. So to interact with what we talk about in the videos, remember, click this icon right there in the forum. That will take you to our Market Outlook forum. You can get there here as well. Ask any questions that you have about anything we talk about in these videos, night in and night out. From a long-term perspective, you can see how we're holding that 200-day moving average. So there's another layer of support level in addition to those Fibonacci lines I showed you before. We're still above there, and we talked about too the expectation. See the highs there at 26.72 on that week, 26.74, just under 26.75 there. So you can see how, and the 50-day moving average that's falling is right now at 26.72. So breakout above 267, excuse me, on SPY it'd be 267.50, 26.75 on the SPX. That would be a positive development. Again, take a look at the Russell 2000, which has been a little bit more bullish. It has gotten back up above its 50-day moving average. Now, we're still 2 days into this week, so keep that in mind. But you can also see how we're not quite above those 2-week highs yet, really significantly either. Let's take a look at the 3 green arrow chart here. You can see we got 2 green arrows still. So as weak as the S&P is, we're just kind of stuck in that 8 and 17-day range. We've got some room to make it up to that 30. And you get above 267.50, again, you'll get above that 30-day moving average too, which will be a positive development. If I move now and look at the near-term drop here on the S&P 500, you can see also the 50% Fibonacci retracement as well as that low point. You bust through multiple layers of resistance on that end. Just not, I mean, those are more shorter term than these longer term Fibonacci retracements on the intermediate and lows and the market sentiment line, as well as that 200-day moving average. And again, you can see the bullish bias here from the momentum. Weak because it's still below zero, but bullish because it's above the moving average and rising. And stochastics too, weak bullish because it's below 50, but it's still above its moving average and rising too. When you take a look at the intraday chart, see how weak today was, and it's a perfectly inside day. Today's trading range stayed right about at 2 points, a little bit more, but right about at 2 points. Definitely in both the high and the low inside of yesterday's trading range. Now, granted, we're more towards the lower end of the range, so a little bit of a bearish bias there, but just a smidge, not really. Pretty neutral candle there. And again, I mentioned that 4-week average. If you take a look at that 4-week average, and again, now that we got that day back in here, there's remember how when we were right here, that's when I drew that line, and I tweeted that out, that there's that possibility that we can form the right shoulder, and you can see that's kind of what we've done. And now the question is, are we going to bust on through and get above this 267.50 level, which is going to be probably a little bit below 267 on this case because of the dividends that are adjusting that. Right? If you take a look, the dividends are pushing it's not exactly 267 to 2670, but you kind of get the idea. 267.50 right there is definitely above all these highs. And then you can also say too that when you look at the 4-week range, which is up here at 277 and down here at 254 and 2/3, the midpoint of that is about 265.5. Right here, we were looking at that in our class today, our inventory trading class. We were right about that midpoint there. So you bust up through here, you're also going to be busting up through from the lower half of this wide 4-week range up into the upper half. And that's typically bullish because remember, you typically break out of to the downside of tight ranges. And when you come up off low points, the ranges don't tighten up down here. They typically stay pretty wide with the volatility. And it's when you cross above that midpoint of the wide range coming off a low point when now you start feeling more bullish about things. When you take a look, remember again, today's neutral candle, small range, look at that volume, really, really low volume. So down to 90 million, so below average, 2 points. That seems pretty negative, but remember, as these lines drop with that low volume and low volatility, that typically coincides with breakouts. Now, you're going to need a big range. We don't need a 5-point move to get to the upside, but you're probably going to need somewhere in the upper half of this 52-week range, so 3-point move or higher when you break up. And you're probably also going to need at least close to 125 million, if not between 125 150 million. If you get that kind of candle and that kind of volume breaking up above 267.50, then we'll know that it's broken through and it's going to hold. Of course, nothing's 100%, but that's, you never know. You'll never have 100%. So all we have is what we have, and what we need is the bigger trading range, at least the upper half of this 52-week range, and the same with the volume, upper half of its 52-week range, if not bigger than that average. And then after that, as we start to trade in the upper half of the 4-week range, you want the volume to start to taper off again. You want the trading ranges to taper off again too. And as these lines drop, we typically bounce. That's the typical pattern as we've seen before in other videos. Okay, now we take a look at the volatility index, the VIX, and you see it's really tightening up too. So we usually don't tighten up at these higher levels and break out to the upside. Usually we tighten up at these higher levels and start to make our way back down below support. And 20 is that layer. And I'm not looking for a big move to the downside. As you can see, we're not falling sharply back down here, and we won't. Volatility is now taking a notch up higher here this calendar year, and that's expected to be the case going forward. But if you look at the regular index here, similar to what we saw back here in 2016, the last time we were this volatile, when the ATR was that big compared to the price, you can see it took about a month or two for it to get back down into this bullish sweet spot, and then stayed down there throughout that March, April into May, and with a little spike in volatility in June. So there's your 90 to 95% range is right here. So after being at 1, which is this point right here, which is where we're at right now, we're kind of staying right around 1 for a long time. After getting below 1 and getting back below into that neutral range, then we got through to the bullish side and stayed down there for a while. And again, that's the expected pattern that we look for now too. Again, still at 1, so we're not back up the truck bullish right now. But you can see how we are looking for that more bullish intermediate trend to develop here in the short term, in the near future, more so than we are a support breakout to the downside where things will get really crazy again. All right, now let's take a look at what's driving the price action today, and it continues to be more out of Washington than it is out of Wall Street. And we had a good discussion on that again today in class about the impacts that these issues from Washington and how long the impacts can be, and they aren't very long lately. They're very temporary negative impacts, at least what we've seen. We've seen that so far today, even with the gap down and filling up the price. Of course, the biggest news is the CPI. You can see the CPI came out on a year-over-year basis, continues to grow with the CPI continues to grow. Now, on the month-over-month basis, it was down because of the energy costs. But again, it's the year-over-year rate, and of course, last March, you can see that big negative number here on the core and the CPI. See how it got negative. So that's kind of why the year-over-year rate's so small. You can see March would be down in this area, but the trend is still. You can read what you want about the gains. The trend's still higher. We're rising, and not just on the headline basis, which includes those food and energy costs, but also on a CPI, a core basis, running up. So pretty decently strong inflation. Of course, that leads to higher interest rate hike expectations, especially with the minutes that came out, where they kind of said that they're on pace and they're not looking to slow down anytime. They're not really speeding up either, but they're not looking to slow it down either. And so that means June is the expected, and you can see how high the odds are for one more hike. That's 175, 200. So 200, 225 would be the second hike. That would be scheduled for September if they keep on the same pace. You see how that jumped up in odds today. Almost about 50% or higher. So it's not as high. And then you can see by December, that third rate hike for the year, 200, 225, is now riding up a lot higher, and you can see that the odds of a fourth hike even turned up today. So even with GDP estimates still not as high as they've been, but of course it always goes this way, and you can see now it's kind of falling in range with and this will be coming out here pretty soon, But you can see how that now we're right about that 2%. And that's a pretty decent number seasonally for the first quarter compared to what we've seen in the past. So we talked about today, if anything that comes out of Washington, how does that impact expectations for the economic growth expectations as well as earnings expectations, because we're heading into earnings season. And that's the reason why a lot of these Fed raids or whatever it is, tweets, the reason why they're having shorter term impacts, negative impacts, trade wars on the markets, is they haven't had that impact yet on economic expectations. And when you look at the economic surprise index, yeah, we're falling down a little bit. We're at 31 with today's numbers, but that's still a high number compared to the last few years, compared to the G10, which is at some of its lowest levels. And that's why I tweeted out yesterday, for those of you who follow me on Twitter, this is the Eurozone's economic surprise index. And you can see that if it wasn't for the U.S. here, that would probably be a lot lower, because the U.S. is still relatively pretty darn high. Yeah, we're off of the highs, but relatively speaking, that's a pretty darn elevated number. So we're still, over a 3-month rolling window, still beating those economic estimates. So from this standpoint, you can see the inventory data had the biggest jump on asset classes. Everything else is pretty flat to sideways. The dollar was flat. Stocks are down a little bit, especially by the end of the day, but they were flat for most of the day. You can see small caps and emerging markets were slightly higher. Long-term bonds are up, so a little bit of a bearish bias, a little bit of a bias towards safety, and gold being up because of weakness in the dollar. That was mostly early in the day. You can see the dollar rallied throughout the day to a close, and that brought these off their high. So this is mostly a dollar and an inventory story. Everything else, pretty darn neutral day today, especially with stocks kind of stuck and mired where they're at this significant volume. One thing that did jump out, we talked a couple days ago about that strangle on XLE. One significant move that we saw today was crude oil. You can see crude oil breaking out here. Let's slide this over. There we go. Nope. That's what I wanted. So there's today's candle, and you can see here, there's the highs that we're kind of breaking out of, and we're pushing up towards that upper band, and that's some pretty decent bullishness. If I were to look at a weekly chart of crude oil, you can see getting back, we're trending higher. Here, let's go to a longer time frame for some perspective on that weekly chart. We're trending higher. We're back up above the 50-day moving average. We're breaking up to new highs. And remember, the next layer of resistance is going to be up in this area, right around, $80 or so is, the next significant. There's going to be some at 70 right there, but that's $80 is going to be your bigger level. 75 to 80 is going to be your bigger level of resistance. So we've got some room for crude oil to run, if that continues to be the case. You can see the breakout and the impact that the breakout in crude oil had, and you can see, since we talked about that that sideways move in XLE, there's your breakout in crude oil stocks, up 4% in 2 days, and technology doing pretty well too. Stocks as a whole up 0.5%, even with. Let's go back and let's look at the since the week started here. So we'll go right here. So there's your almost 5% gain in energy. There's technology up 2%. You can see stocks pulling back a little bit. Remember the weakness we had last week, bouncing up yesterday up to over 2% for the week before pulling slightly back. Still up 1.5% for the week, so still a strong move. And you can see, safe haven areas either negative for the week or flat. And then you have these consumer, financials, industrials, these kind of more bullish, typically bullish sectors pulling back. Technology still holding up some strong gains, along with healthcare outperforming, materials and energy outperforming, with weakness in the dollar. You take a look at the dollar index here. You see that weakness in the dollar showing up, looking like it's trying to break out here to the downside. We'll take a look at the Bollinger Band. You see how we're making a move now this week to the downside. Still very, very tight, still waiting for a breakout of this coil one way or the other. And that's going to impact gold and crude oil. You can see gold's trying to break out. Got a long upper shadow though, so that's not the best sign. Every time you get the long upper shadows is when we typically hit this resistance and roll over. Long lower shadows the same on the other side. So not the best sign to see that long upper shadow there, and we'll see if that continues to be the case. But if we break it back out and still push higher on gold and on crude with the breakout there, you would expect then this dollar to break out of this coil to the downside, which means we could get some extended moves in weakness in the dollar and extended moves in gold and crude oil, which means opportunities in these materials and energy sectors, since they are, they do better when the dollar is weaker. All right, when you take a look at, for our trade idea of the day, in that energy sector, the stocks are, have been looking good, starting to look better. Yesterday getting, some 3 green arrows. Today, getting some continuation, not quite getting above the 67.5. So not quite to the bullish where we're buy a call option or buy the stock and let this thing run. You've got earnings coming up too that can have an impact on things. Last year, this earnings had a negative impact, and you can see all the other earnings kind of make their moves within the ranges of where the stock was trading here. All of these other moves, you can see we were moving to the downside by the time we got that one. We were moving to the upside by the time we got that one. Here we're kind of sideways, waiting for a breakout move, really. And here we had similar there, where we were sideways move. You got earnings, and it just stayed in the sideways move. So I'm not too worried about it earnings kind of breaking us out one way or the other. Because I'm not really, we don't have a breakout yet, one way or the other on this range. You can see how, with the Bollinger Band, we're getting up to the upper end of the Bollinger Band. We're starting to clear a lot of the volume. A lot of the volume over this past year has been in this area right here. So there's still some support up in this area, but you can see we're starting to get out of that. If we were to take a look at a smaller time frame, like 6 months here, you can see now how we're starting to clear all this volume, and that's today's move is kind of a good sign to get up above the highest price with the most volume that we've had. And of course, going back even further, going to the smallest time frame we want to use on this daily chart, the 3 month. See how we're getting above all that volume, and there's a dearth of volume in this area, which means it's easy to fill that up. We can get a decent move up to about 74, which happens to be about 1 standard deviation move right now. So there's not a lot of action that's holding it back. It's just not quite there. So that's why we say okay. And you can see too when you look at like the MACD and stochastics, you see how that MACD is starting to cross above 0. Stochastics getting above 50. You look at the market forecast and the intermediate lines crossing above 50. So pretty decent sign that things are starting to move higher here. So that being said, let's take a look at an opportunity for a trade. Again, we don't necessarily want to buy a call option that's bullish. At 67.5, if I were to buy a call option in May, because again by May we're looking for opportunity that can go all the way up to 74, right? So if it were to do that, if I were to do this Theo price by May 19th. May 19th here. If we were to get up to, what would it be, 45 cents, 6.45. Yep. So if it were to get up to 74, then you can see this 67.5 call option would be worth $6.50. This $1.50 call option would be worth $4. So we'd have way more than four. I don't. My math on top of my head doesn't seem to work very well. So I'll bring out my calculator. It'd be a 150% gain on that at the money option. It would be a 166% gain on this option here, the 70, and you can see that this option here, 150 divided by 80, would be an 87% gain, right? Yep, 87% gain for that one. And you can see buying the 75, I'd lose all 41 cents. Because again, we're only expecting it to get to 64. If I go further in the money, The $65 call option would be worth 116%. So now we're starting to go down that direction, right? The 1150 divided by 605 would be a 90% move. So we're starting to go down in that direction. So it seems like these two are the best bets, but again, we're not that bullish. So how about we say, okay, how about we do this? We buy this 67, gives us that opportunity, but then we'll sell the 70 and reduce our costs, so reduce our risk down to 112. And then you can see, yeah, we're capping my gains at 130, we're capping my losses at 112, capping my gains at 138, but it gives me a better odds now of achieving that that gain at 138. You can see without it, to make $138 on the 67.5, if I were to analyze that trade, move this up a little bit. So for me to get to $138 gain on the green line here at expiration, we'd have to get all the way up to 71.5 versus 70 for this one. Now I can make more. If we get up to 71.5, I can make more. So there's the alternative. If you're really bullish, think we can get up to 74 as we fill in that gap, then buying the call option by itself, as we saw, would give us our best bet. In fact, buying the $70 call option would be our best bet, because that gives us a better chance over here. But you see, for me to get to 138, we'd have to get all the way over there for that to happen. We have to get all the way to $138 gain on a, well, let's see, no, sorry, there we go. $138 gain would be right over here to 73 almost. We have to get almost to 73 versus 70 for the vertical spread. So you can see now, yeah, I'm only spending $150 versus 112, but I get a higher chance of getting my 138 gain with the vertical spread. Then I don't have to worry about time decay, right? So that's the benefit here. I don't have to worry about time decay on the vertical spread or volatility impacts that are going to be a lot bigger here on the long call by itself if we were just kind of meander around for a while at this resistance level. So that wraps us up for today. So thank you as always for watching our video tonight. Remember to subscribe, like, and comment down below on the YouTube channel. Remember also to do the same on the blog if you're watching us on the Market Scholars blog. We appreciate you watching these videos. It's a lot of effort for us to put these out there. It's a lot of time for you to watch them. We understand that time is valuable. So thank you very much, and let us know if you want us to keep doing these day in and day out with the likes, with the one-click likes on this channel or on the blog there, as I mentioned. So kind of an interesting day. We're kind of setting up for a move one way or the other. And as always, as we do make that move, keep watching these videos to know how that changes or affects or impacts expectations going forward, and what we're going to do about it. So have a great evening, everybody. We'll see you all tomorrow.